Today's show is the second part of our two-part series on year-end tax reduction strategies. We're going to talk about Roth conversions, charitable strategies. I've got other strategies that we're going to talk about. We're going to talk about annual gifting, and then we're going to wrap up with how to avoid the big surprise.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and today we're going to talk about your taxes. I'm your host, Scott Searins. I run a retirement planning and investment management firm where our mission is to help good people make great financial decisions to maximize their retirement story. And to help maximize your retirement story, one of the things that you can do is reduce your taxes. If you reduce your taxes, it's less that you pay to the IRS, which means more money in your pocket to do the things that you want to do to maximize your retirement story. So that's why today is part 2 of our year-end tax planning discussions. If you want, I'll include a link in the show notes in the description to part 1. So in part 1, we discussed what makes up taxable income, what does taxable income mean, and how does this drive your current and your future tax rates and how much you'll pay to the IRS. We discussed what a tax projection is. We discussed tax planning versus tax preparation. And then we got started into some year-end tax planning strategies and ideas and actions that you could take, all about your workplace retirement plan. So that was all in part 1. You can see that. Again, we'll include a link in the show notes. You can go back and watch that if you have any questions on those specific topics. But in part 2, we're going to focus more on strategies, actions that you can take, again, to help reduce that long-term tax burden. A lot of times we can get so focused in the now, so focused in the today, and it's great to live in the moment, right? It is good to focus when it comes to just a personal standpoint on today and what you're doing today. But to help maximize your retirement story, which means reducing your taxes, we not only need to focus on today, we got to focus on the long-term picture. And so we need to understand what actions, what strategies can you do today to help reduce that long-term picture. So today we're going to talk about Roth conversions, talk about charitable strategies. I've got a list of, just call it miscellaneous strategies that you might need to look into. We're going to talk a little bit about legacy planning strategies. And then the last one that we're going to talk about is how you can avoid the big surprise come next April. So stick around to the end. We're going to talk about avoiding that big surprise. Now, the reason why we're talking about this now in October is because some of these will have a deadline of the end of the year, that if you want to take action on these strategies, they've got a December 31st deadline. Another reason that we're talking about them now in October before the December 31st deadline is we also only have a couple years left of the Tax Cuts and Jobs Act that reduced tax rates across the board. And in 2026, tax rates are scheduled to go back up. It's a kind of a different law in Congress. This one had an expiration date to it. So it expires December 31st, 2025. If there's no renewal of the plan, well, then tax rates are going to go back up. So why not take advantage of tax rates while they're on sale? In the event that they do go back up, you've now taken advantage of current times. So let's start with the first one, which is all about utilizing those lower tax rates, and that's Roth conversions. And I'm sure you've heard the term. I'm guessing that you've maybe thought about it, you've read an article about it, but this is one of the strategies that you should look into by the end of the year. Always consult your financial professional and your tax preparer when it comes to Roth conversions. But essentially what it is from a high level is you're going to take money from your IRA, convert it over to your Roth IRA. And when you do so, you're going to pay tax on that conversion. Essentially what you're doing is you're paying tax in advance on your money. Well, why would you want to do that? Again, if tax rates go up in the future, you've paid taxes while they're on sale. You got a sale on the money in your IRA, because that IRA money, when it comes out, you're going to have to pay ordinary income tax on it. So if you pay that tax today while taxes are on sale, then you've actually gotten a discount of what you're going to pay to the IRS. Think about it this way. You just want to pay what you legally have to, but there's no need to leave the IRS a tip. So maybe a visual here will help you out a little bit. And if you're listening to this on your favorite podcast player, I recommend going to lifemoneyshow.com to take a look at the video and the visuals that I'm going to show, but I'll try to explain this as best as possible. So in part 1, we gave a scenario of Steve and Sue sample, and I gave you all the details in regards to them, so you can go back to part 1 to watch that. But what we did is we used Steve and Sue, used their all of their information to project their taxable income. And then we looked at their taxable income. We said, what are their tax rates going to be? And so here's a reminder of what their future tax rates look like. Right now, they are in the 22% bracket. When they retire, guess what? Taxes go down, then they need some income, then they take Social Security, taxes go down again. Oh, and then right there you see at age 75 for Steve and Sue sample, that's when they're going to start taking their required minimum distributions. Their tax rates jump from the 15% bracket up to the 25% bracket. And then another thing, if somebody passes away, doesn't matter who, they're going to jump from the 25% bracket to the 28%. Again, just a projection, but this is then where that Roth conversion comes in. Would they rather pay 28% on their IRA dollars in their future, or do you think they'd rather pay 22% today, or 10% in their retirement, or 15% in part of their retirement? Of course, we'd all love to pay lower taxes on our money. And I get it, that's the tax brackets, and we're in a progressive system here in the US, but it's just an easy way to help you look at and visualize why you might want to do a Roth conversion. Because now they're in a lower tax bracket than what they'll be in their 70s and 80s when they're in the 25 or 28% bracket. So I actually just ran the simulation. I said, hey, what happens if Steve and Sue sample here? You can see at the bottom, we said fill up the bracket. So Roth conversions are very strategic, meaning a lot of times people hear Roth conversions and are like, boy, that sounds like a great idea. I want to get all of the money out of my IRA. I want to put it in my Roth IRA because I know it's going to grow tax-free. Withdrawals are tax-free. And what they're thinking is that they'll just do it in one big lump sum. Now, if Steve and Sue sample did that, that would put them up into the 30% tax bracket. They'll never see the 30% tax bracket in their future. So why would they want to pay 30% now? So Roth conversions can be very strategic, where you go up to the top of a certain tax bracket with your conversion, right? So you're adding in more taxable income. Let me just show you here. So we said, let's fill up the 22% tax bracket, which then becomes the 25% tax bracket in the expiration. So before, when I was showing you this, the blue was their current taxable income. The green now in our picture is them taking from their IRA, converting it to their Roth, to go up to the top of a tax bracket, but not go over. So that's a strategic Roth conversion planning. And then if we go to our summary chart here, as you can see, and again, these are just projections, but it's projecting that they'll not only have, more future assets, but almost $400,000 less taxes paid to the IRS over their lifetime. And again, just by doing some advanced planning and some tax planning in regards to their situation. So Roth conversions is something that you want to consider. This is something that does have a December 31st deadline to make your Roth conversions happen. Next on the year-end tax planning, tax reduction strategy checklist is charitable strategies. If this doesn't apply to you, just hit fast forward. But it may apply to you because you might be thinking, well, I give to charities, but the standard deduction is so high, I'm not able to itemize my taxes anymore. And this is what's really happened for a lot of people. The standard deduction in 2017 went up. And for a lot of people, based on what they give to charitable organizations, they're not actually itemizing their taxes right now, or they're keeping track of all the receipts. They're turning them into their tax preparer, and come to find out once they, fill out their taxes and submit them, they didn't get a chance to itemize based on maybe some really healthy charitable contributions that they're giving. So there might be some ways around it. It just depends on your situation. So I'm going to walk you through a few different strategies. We do have videos on a couple of these. So rather than go in depth into detail on them, I'm going to point you to those videos so that way you can go as in depth into these different strategies that you want to. So if you're someone who is giving to a charitable organization, again, you may not be writing off or itemizing those charitable deductions because of the standard deduction that is high right now, which then overpowers your itemizations. But there might be some ways around that. So one way around that, and we actually were just talking about this in the office the other day with a couple, is what we call is bunching your donations, bunching your contributions. What does bunching mean? Well, it means that, let's just say, and I'm just going to use easy numbers to help you understand. Let's say you're giving $10,000 this year to different organizations. Well, if you take that $10,000 and then again for itemization, you add in property taxes, mortgage interest, etc. If that's not exceeding somewhere around, call it $28,000 to $30,000, depending on how old you are, you're not itemizing your taxes. So what we discussed in their situation was what we called bunching, is that they would take their, their charitable contributions for this year that they've already done, great. And then they would take their charitable contributions for next year, but instead of doing those next year, they'd actually bring them into the end of this year. And I know what you might be thinking, well, but that, then I'm not doing it next year. Well, maybe just have a conversation with the organization to be like, hey, we're going to give you next year's, contributions, but we're just going to do it in advance. Helps us out, still helps you out. It's kind of a win-win scenario. So that's bunching, is bringing kind of 2 years into 1 year to be able to then potentially itemize your taxes, get that deduction for giving to the charitable organizations. Now, the other few that I've got, or couple that I've got written down here, is donor advised funds. Maybe you've heard that name, maybe you've already seen our video on it, but that is a strategy as well. Just like bunching, need to have that wrapped up by the end of this year. Donor advised funds, need to have that wrapped up by the end of the year. I'm going to include a link in the description so you can go to see the video on donor advised funds, how those work. And then the last one, let's just say that you're age 70 and a half or older, would be the qualified charitable distribution. So as we had talked earlier, those required minimum distributions, the forced income that you're going to have to take from your IRAs, well, there's a way to reduce that. And one of the ways to reduce that is to give to a charity directly from your IRA. Now, you have to be age 70 and a half to do so. And of course, you've got to have an IRA to be able to do so. But that's a way to reduce your taxable income. All of these ways, all of these things are ways to reduce your taxable income, which then reduces your taxes, which helps keep more money in your pocket for things that you want to do, or maybe to continue to give more to charity. So we also have a video on the QCDs, qualified charitable distributions. I'll include that in the links below as well. All right, well, hopefully you're enjoying this list so far in the conversation. You're kind of seeing some different strategies, actions that you may need to look into to help reduce your long-term taxes. This is why, each and every year with our clients, we have a year-end tax planning meeting, because not only do we want to just think about these items and talk about the items, but we want to take action on the items. That's how you actually reduce your taxes from a long-term standpoint, is taking action on the strategies. You can talk about them, you can listen to them all the time, over and over and over, but until you actually take action, nothing's going to happen. So that's the biggest point. Take action on the strategies. And if you're having troubles doing that, well, then seek out guidance, seek out help to be able to take action on the strategies that may help you reduce your long-term tax burden. Okay, so some miscellaneous items, and then we're going to talk about some legacy and gifting items, and then get to that big surprise. So one thing, we do work with clients that have stock options. One thing that if you have stock options that you should be looking at considering is when your stock options should be exercised. So let's just say your stock options were going to expire come next January or February. Well, you should really take a look at your income for this year and your income for next year. And yes, while you want to get the most growth out of the stock in your company, but getting that growth can potentially mean to more taxes. So look at your income for next year, look at your income for this year. What we've done in some situations and scenarios with clients is we've had them exercise some or a partial amount of stock options this year. So that way, it helps get them up maybe to a certain tax bracket without going over. And then they do the remainder next year. So it's understanding, where do your taxes sit this year? Where do your taxes sit in the future? What's the price of the company? Where do you see potential growth? Having that big overall discussion and then taking action, because maybe it does make sense to do some this year. Or maybe it makes sense the opposite. Delay everything until next year because your taxable income might change next year and be lower. So you have to understand, where does everything sit, and then make some good judgment calls on, things that you can control, like exercising stock options. Another thing to look into, again, this would have to be done before December 31st, is tax harvesting. This would be if you have an individual account or a brokerage account or a trust account. What tax harvesting is it's harvesting gains or losses in your account. Now you might be thinking, why in the heck would anybody want to harvest gains? Well, maybe you have some carry forward losses from previous years. Why would you have carry forward losses? Well, you can only write off up to $3,000 in losses on your taxes. So if you had more than $3,000, you're essentially carrying those forward each and every year. So something that you can do with those carry forward losses is you can use them to write off gains or harvest gains in different stocks in your account. So, think about that. Like at some point in time, if you're going to go and sell or take income from that account, when you sell, you may have gains. Those gains lead to taxes. But if you take carry forward losses and you sell, basically those wash each other out. You don't have any gains. So tax loss harvesting is one thing, but you also want to consider tax gain harvesting. So these are things that you want to do in those types of accounts before the end of the year. Now, I'm not saying to go in and churn your account and be trading all the time, and you have to be very careful with short-term gains versus long-term gains, because short-term gains are going to cost you more in taxes. But you want to be strategic about it. You want to be taking a good approach that's going to help your overall long-term tax picture. So when you're looking at those brokerage accounts, those trust accounts, those individual accounts, sometimes the best thing to do is nothing. But if you do have, some things available to you like carry forward losses, well, then you may want to consider, harvesting some gains. Another reason you might want to harvest some gains is maybe you sit in a very low tax bracket. Maybe you've retired early. You've got zero taxable income coming in. Well, there is a certain threshold where you can get long-term capital gains at a 0% rate. So maybe you take advantage of that and harvest some of your gains to get those long-term gains at a 0% rate. Give you one example is that, in working with someone this year, one of the things that we're doing is they've retired early. They've decided to delay their Social Security. They're living off of their brokerage account. We're going to do Roth conversions basically up until we hit the capital gains threshold. So that way they've gotten all of their gains this year in their accounts at a 0% tax rate. Again, all strategic thinking, strategic planning, but by doing so, you might be able to reduce your taxes. The next one I want to talk about here in the checklist is annual gifting, or the annual gift exclusion. So each and every year, there's the annual gift exclusion amount that you can give to basically give a gift of money to someone where neither of you have to fill out any tax forms. So we're in 2024. This year, the amount is $18,000. Let me just give you a good example here. Let's say Steve and Sue have one child. And let's just say the child's name is Johnny, right? So Steve could gift Johnny $18,000. Johnny doesn't have to fill out any paperwork. Steve doesn't have to fill out any paperwork. Sue could also gift Johnny $18,000. Neither person has to fill out any paperwork. Why would you want to do this? And some of you might be like, I save this money. It's for myself. Well, great. That's maybe what you want to do. Some people, want to help out their children. Some people want to pass on a legacy. Some people might have a state or federal estate tax problem, and this is where it comes in. By doing this, let's just say you have a state or federal estate tax problem. You're now getting money out of your estate tax problem and gifting it to your child. Again, staying within those limits. Nobody has to fill out any tax forms, and you're now starting to kind of transfer that wealth to the next generation. Some people maybe just want to help their children out. They do want to give, and they're like, instead of a legacy later on where they don't get to, see or have any of the joy of that giving because it was after they passed away, they want to do it while they're alive. Again, this is just another way to be able to do so where they are gifting to their children. Doing it within the amount of the annual gift exclusion can just help, reduce any sort of paperwork that you have to think about or worry about. So there's something, but again, that has a December 31st deadline that you need to consider. All right, so the last one that I had mentioned, which is avoiding that big surprise come next April. So what am I talking about there? Well, the big surprise come next April would be your tax bill, and if you owe anything on taxes. I find a lot of times that for people, especially as they go into retirement, that's a whole new arena where they no longer have their company paycheck anymore. They've been, shifting to Social Security or shifting to a pension or shifting to IRA withdrawals. Now, what we do for our clients is we withhold federal taxes from their IRA withdrawals if they need to, based on tax projections. But a good thing to do before the end of the year is a tax projection for the current year. So based on all of the sources of income that you've got coming in for this year, what will your taxable income be? What does that then lead into for how much you'll owe in taxes? And then what you want to do is compare that to how much you've already withheld for taxes. And then you'll know, will you have a shortfall? Have you paid in too much? So you're going to get a refund next year. And you can really understand where you sit. But even more importantly, I find a lot of people don't like to pay in taxes come next April. So it's going to help you avoid that big surprise of paying taxes next April. Now, another thing that you really want to, another reason why you may really want to consider this is if you've gotten a big bonus at work. I find a lot of times that when you get a big bonus at work, if your company doesn't change the withholding amount on that bonus, you may, if you're kind of sticking with your general withholding amount, they might not be withholding enough. And so there's been a few times where we've done tax projections. Clients have gotten a big bonus, and then because of that big bonus, we find out that they're going to have a tax surprise, that they're going to owe money next year because the company didn't withhold enough, or they didn't tell the company to withhold enough. So a lot of different reasons why you want to do that. And I'm guessing you, like me, would want to know now that you need to start planning for what you're going to owe in April if you're going to owe something, versus finding out in April and maybe it already allocated or spent that money in other directions. So hopefully that helps you avoid the big surprise. I find people, again, don't like getting those surprise tax bills come next April. So hopefully you found the the show today to be helpful, to be of benefit. Hopefully this is a checklist. Again, hit rewind, go back to part 1, watch that, watch part 2 again, start taking notes. I mean, we have I think there's 40 to 50 points on a checklist that we go through each and every year for our clients for tax reduction strategies. I just try to pick out the ones that are primarily used today, but I hope that you get an opportunity then to really take a look at your situation to say, can we take some of these things? Can we implement them? And then the bigger thing is taking action on the ideas. So hopefully you found it to be of value and benefit. If so, don't forget, subscribe on your favorite podcast player. If you're on YouTube, subscribe there. That way you get notified as we're coming out with new videos each and every week to help you maximize your retirement story. Thanks. Have a great day.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.